Welcome to the Pro Ticker Deep Dive.
For what? The last 18 months, if you asked any investor where the action was, the answer was always the same.
AI. And really just one corner of AI.
Oh, absolutely. The Magnificent Seven. NVIDIA, Microsoft, Google. They weren't just stocks, they were the narrative. They drove basically all of the S&P 500's gains. It was the consensus trade.
The easiest trade on the street. Okay, so let's unpack this because our sources are crystal clear that in December 2025, that whole consensus just cracked.
It wasn't a crash, not really.
No, but the music definitely changed, a new tempo. And that signals a huge structural shift. So our mission today is to figure out why capital is finally trickling out of those mega cap plays, the ones everyone owned.
And more importantly, where that sophisticated money is now placing its bets for, say, the next year or so through 2026.
Right. This isn't just a minor correction. We're talking about a fundamental rotation in the AI trade itself.
And what's fascinating is that this fragmentation, it wasn't driven by some big external news event. It was driven by two really uncomfortable truths that just became too big for the market to ignore.
And the first one is just math.
Pure, brutal mathematics. The valuations in the Mag 7 got stretched beyond, any historical norm we've seen in modern tech.
Give us the poster child for that strain.
It has to be NVIDIA. For 2 years, they were the undisputed king, untouchable. But by late 2025, its price-to-sales ratio had climbed to nearly 27.
27 times sales.
Just think about that. For every single dollar of sales NVIDIA made, investors were paying $27 to own a piece of it. That is almost 5 times the average for other semiconductor stocks.
The market was pricing in perfection forever.
Infinite exponential growth. And eventually, the physics of money just says, no, that can't be sustained.
And that second truth, it hits the much colder reality of the business world. If valuation is the theoretical problem, what was the practical one?
The practical one is that the actual returns on all this massive AI capital expenditure, the CapEx, it's still theoretical for most companies.
So they're spending billions on chips and cloud.
Billions. But the actual quantifiable profit from it all, it's hazy at best.
And that uncertainty, it just exploded in December. The overall market drop wasn't even that dramatic. The S&P fell, 0.86%?
Yeah, and the NASDAQ dropped about 1.25% that week. But the real signal was the volume. NVIDIA tumbled 3.36% in one day.
On huge volume.
204 million shares traded. That is not just a few people taking profits. That's big institutional money making a deliberate, aggressive exit. The smart money was repositioning.
And then Oracle just threw gasoline on the fire. Their earnings miss, and then their guidance, it amplified that CapEx fear.
It shocked the street. They announced their capital spending was going to accelerate to an unbelievable $50 billion next year.
Which is a $15 billion jump from what everyone was expecting.
Right, and that's the moment the market just froze and realized the game had changed. That $50 billion isn't going into new offices, it's all going into AI infrastructure.
And it raises that really dangerous question. At what point does all this AI spending become value destructive?
Exactly. If you have to keep dumping tens of billions in CapEx every year just to stay in the game, is your return on that capital even positive?
So for 2 years, AI was the ultimate risk-on trade. Buy anything with AI in the name, ask questions later. Now skepticism is finally setting in.
And it's forcing this rotation from what you might call pure play AI bets into what strategists are now calling the utility phase.
Moving from poetry to plumbing.
That's a great way to put it. And we have the data to back up this newfound sobriety. There was a critical finding from an MIT study making the rounds on Wall Street.
I saw this. It said that approximately 95% of organizations deploying large-scale generative AI found, what was it?
0 return on their investment.
0. That's just staggering. How do you spend that much money and get literally nothing back?
Because they were investing in the wrong kind of AI. The first wave, the chatbots and image generators, they're great for drafting an email or making a fun picture.
But those things are really hard to monetize directly.
Especially if the output still needs a human to check it, which most complex business tasks do. If your fancy internal chatbot can't directly generate revenue or reliably cut a specific cost, it's just a very expensive cost center.
So the market is demanding accountability. And the solution that everyone's now fixated on is agentic AI.
Agentic AI is suddenly the phrase of the day.
So what's the real difference here that makes it so much more valuable than a fancy chatbot?
It's a functional leap. Unlike those older models, agentic AI systems are Well, they're autonomous software agents. They're built to execute complex, multi-step workflows on their own.
Without constant human handholding.
Exactly. No constant prompting or oversight. So instead of asking a chatbot to summarize a legal document,
You're telling an agent, go audit every single contract from last quarter for compliance gaps and report back.
precisely, we're talking concrete, measurable tasks. Real-time auditing, autonomous code generation, supply chain optimization. Stuff that results in verifiable cost savings.
So measurable ROI is the key word.
Absolutely. And the industry data shows it. Something like 40% of enterprise workflows now have agentic components. And critically, these systems are delivering that quantifiable ROI.
And right as this is happening, the Fed pivots.
Right. The Fed's moved to a more accommodative policy, cutting rates, it added liquidity. But it wasn't a tide that lifted all ships this time.
No, especially not the most expensive ones.
It just made capital more mobile and way more selective. It's hunting for those demonstrable returns now, not just hype.
Okay, so let's connect that back to market structure. The concentration in the Mag 7, which drove, 85% of the S&P's gains since early 2024, was just unsustainable.
And now that capital is mobile and selective, it's flowing into three very distinct, let's call them lower concentration buckets.
All right, let's break down these three new destinations for capital. Bucket 1. Semiconductor specialists with reasonable valuations. So we're looking for alternatives to NVIDIA.
Or at least the co-beneficiaries. The big name here is Broadcom, ticker AVGO.
Analysts are calling it the Mag 7.5.
It's a bit of a stretch, but you see why. They're the essential infrastructure layer beneath the Mag 7. They just reported a stunning 28% quarter-over-quarter AI revenue increase.
And guided for more.
Guided for another 19 to 20% sequential growth.
But why Broadcom specifically? Why not just buy NVIDIA on the dip?
Because the hyperscalers, Amazon, Google, they learned a very painful lesson about being locked into one vendor. They're all moving toward custom silicon.
Right, Amazon's Trainium or Google's TPU.
Exactly, to manage costs and control their own supply. And Broadcom, along with TSMC, benefits massively from making those complex custom chips. They're selling the picks and shovels to everyone trying to get away from NVIDIA's high margins.
And the key part, the valuation is more palatable. AVGO is trading at 39 times forward earnings now.
Which is way down from its peak of 68x. You're still paying a premium, but it's not the astronomical price you were paying for NVIDIA.
We saw AMD pop on this theme, too.
Oh, yeah. Their new data center chip announcement sent the stock surging as much as 20% in one day. It just confirms the market is desperate for competition.
Okay, so from hardware to software. Bucket 2. Infrastructure software beneficiaries. And this brings us right to Palantir, PLTR.
Palantir has played this shift just brilliantly. They've managed to completely rebrand their narrative to be the platform for secure, complex, agentic AI.
They're capturing those high-stakes deals, government, high-security enterprise.
The ones where autonomous agents are handling sensitive data. Deals that the Mag 7, frankly, can't service because of trust or integration issues. Technically, the stock is in a textbook bull setup.
But we have to address the elephant in the room. I mean, you can't ignore it. That valuation is genuinely terrifying.
It is the ultimate high-wire act of this rotation. You're looking at a $180 billion market cap.
On less than $3 billion in annual revenue.
Do the math. That's a 60 times revenue multiple. You're not betting on a business. You're betting on a miracle of adoption.
So if agentic AI hits any kind of regulatory speed bump,
Palantir has further to fall than almost any other stock in the entire sector. It's a huge risk.
So investors are trading the valuation certainty of the Mag 7 for this potential hypergrowth, but with extreme risk attached.
That's the rotation in a nutshell. Less concentration, but more selective targeted risk.
And that brings us to the final one, bucket 3. Sectoral rotation. This is capital leaving that narrow tech focus entirely and going into, well, old school sectors.
Value and cyclicals. The data is clear. The Russell 1000 Value Index surged in November 2025, right as the growth index stumbled.
And the money is flowing into materials, industrials, financials.
Right, the sectors that benefit from lower interest rates and a stable economy.
But how does this connect back to the AI theme? Why are we talking about steel and banks in a deep dive on agentic AI?
Because the AI infrastructure boom is a profoundly physical thing, those data centers require immense construction that boosts industrials and materials stocks.
And the power consumption.
Don't forget the power. Energy stocks rebounded sharply because they are the true foundational beneficiary of this AI capex cycle. Those massive data centers that Oracle and others are building consume unbelievable amounts of power. AI needs energy.
So it's a value play, but with an AI tailwind driving the actual demand. We're seeing it in healthcare, too. Companies like Becton Dickinson, BDX.
They benefit from AI for efficiency as a supplement to their existing profitable business, but they don't carry that insane valuation premium.
So this is a healthy rebalancing then. What's the bull case for this rotation?
The optimistic view is that this is fundamentally healthy. The Mag 7's dominance was never sustainable. This is just a natural market mean reversion, not a rejection of AI.
And this correction creates opportunities elsewhere.
Absolutely. Long-term outperformance in less crowded names. Broadcom is the perfect example. A company whose custom AI chip business is growing faster than the rest of the industry, filling a huge demand gap.
Okay, so that's the bull case. What's the bear case? What could make this whole thing disorderly?
The first and biggest issue is just the sheer scale of the capex we talked about. You aggregate the spending across Microsoft, Google, Amazon, Meta, Oracle. You're easily looking at over $200 billion a year.
And the fear is that this spending won't yield a decent return, especially if we see a commoditization of inference. Can you break that down for us?
Sure. So inference is just the act of using the AI model after it's been trained. Training is expensive, but eventually running the model to answer a question gets very cheap.
So the service becomes a commodity.
Right. If the cost of running these models collapses because the hardware gets too good or everyone offers the same service, then that huge $200 billion investment suddenly becomes a low-margin business. That's a massive sunk cost.
That makes the Oracle investment feel less like a promise and more like a liability.
It could be. And then you have escalating geopolitical risks. We're seeing the rise of sovereign AI.
Where countries want their own AI infrastructure.
Exactly. Japan just announced a $191 billion stimulus to explicitly reduce its dependence on U.S. players like NVIDIA. That fragments the global market and shrinks the total addressable market for the U.S. leaders.
And the final risk is regulation, specifically around agentic AI.
Yes. As these agents become autonomous, making real economic decisions, the question of accountability becomes huge. Agentic accountability.
Meaning, who's liable when an AI agent messes up?
If an autonomous agent causes a financial loss, the liability could fall on the platform owners like Palantir or even the chip makers. That means new compliance costs, more friction, and ultimately margin compression.
So what's really happening is a big overdue risk repricing. The market is finally admitting that AI isn't a free lunch. It's transformative, yes, but it's not a guaranteed 40% return every year.
The reality is messier. It's more expensive and riskier than the initial hype. For those who like the technicals, market breadth confirms this. The number of advancing stocks versus declining stocks turned negative in mid-December for the first time since October. That confirms the fragmentation is widespread.
And NVIDIA's chart shows that exhaustion. It's trading around 183 Lars. Its 50-day moving average is declining. That's a bearish signal.
And volume on the down days is higher. The intermediate uptrend is broken. Compare that to Broadcom, AVGO. It pulled back, yes, but it's trading below its 50-day, but still above its 200-day moving average.
Which suggests a pullback within a longer-term uptrend.
Exactly. It's a much healthier-looking chart, suggesting institutions might be waiting to accumulate on this weakness.
So the final takeaway is clear. The AI trade is not over, but the consensus on how to play it has completely fractured.
We are entering an era where demonstrable profitability matters again. The money is moving from the promise of AI to the utility of AI.
The fragmentation isn't a crisis then. It's a rebalancing. The big question for the next 12 months is, was this just a sharp correction before the Mag 7 takeover again?
Or was this the start of a genuine, multi-year restructuring toward value and utility over hype? And you, as an investor, really need to decide which bucket you want to be in. The one that passively held the old consensus, or the one that's selectively rotating into what's next?
See you all on the next Pro Ticker Deep Dive.